Hello everyone and welcome to today's session on the latest developments in equities and the markets and the outlook for India and globally. Thank you for joining us. I am Shalini and today we have with us B. Gop Kumar, CEO and MD Axis Mutual Fund, and Shreyas Devalkar, Head Equity at Axis Mutual Fund. We usually try to periodically come and talk to you guys about the markets, the way they are, at various points in time, and talk to you on how you should progress in your investment journey. So before we proceed, let me take a few minutes to introduce both Gop and Shreyas. Now, Gop, we fondly call him Gop. His name is B. Gop Kumar. He has almost 3 decades of experience in the financial services industry, and he has successfully navigated challenging roles in sales and distribution and marketing. Prior to this, he was the MD and CEO of Axis Securities, and he has chaired leadership positions at several reputed firms, including Reliance Securities and Kota Group. He passionately believes that technology-driven solutions are imperative to empower investors and partners to unlock the true potential of Indian financial services landscape. And this is what actually we see him doing here. He's very passionate about marketing and technology at Axis too. Now, Shreyas has joined us in 2016 as a fund manager, and he became head equity in 2023. Prior to joining Axis, Shreyas was associated with BNP Paribas as a fund manager for more than 5 years. He has also worked as a research analyst at IDFC Asset Management and IDFC Securities. Now, before we begin and I hand over the floor to both of these, I would like you to use your chat box and ask us any questions that you may have. And we'll keep answering your questions live as and when they come. So, Shreyas and Gop, welcome to both of you. And my first question is to you, Gop, and it is in 3 parts, so please bear with me. 1, can you first start by providing an overview of the way the markets have been in terms of tariffs, the way it has been imposed on all countries? Secondly, given the 90 days pause that has happened, which has been a recent development, how do you see the scenario playing out? And third, specific to India, what do you think, how will this environment play out?
Thanks for Shalini for a good introduction. Thanks, Shreyas. I think we're doing it first time. Looks like after a long time. Tariffs. I think wherever you read we talk about tariffs. So when you look at tariffs, it ranges around from 49% in Cambodia to 10% in Singapore. I think these are so-called rate lists which is available across. My view is that it's changing very dynamically. I think as we speak today, there is a huge war between US and China. I think what I want you to think about from an investor perspective is that how does last 20 years look like from a trade perspective? If you look at late 90s, the world came together and said that we need to have trade each other, and how does this trade the box together? And I think there are a lot of trade agreements were signed across. The theme of globalization became much more stronger. I think India also went through a large liberalization in 94. I think if you look at the beneficiary of this globalization was Indian capital markets. Indian capital markets did extremely well. Companies grew. A lot of companies started looking at global opportunities. All these things happened. I think cut short when you look at from a COVID perspective, and if you look at somewhere in 2022, globally the countries started looking inward and started building their own boundaries to safeguard the nation. I think that's playing out much faster. If you look at most of the across the world, this is what we've been hearing for the last 5 years. I think we started playing here the way it is look like from a global perspective. There is also economic theory about purchase parities and all these things coming and playing. But having said that, more and more economies are looking inward and try to protect their countries, and that's what is going to play much stronger going forward. I think that's my view in terms of the way tariffs will play out. 90-day, yes, we got some respite. We don't know. There is still more BTA bilateral agreements supposed to be signed. What negotiations the government is going to do, it's a wait and watch for us to think about it. I don't want to speculate. I think more important from a domestic perspective is that we also need to look at how the corporate earnings should look like from a Q4 perspective, because we already have one one or two companies have come and given the results, especially large IT company. I think my worry will be also for next 90 days is to look at how the earnings space looks like from a listed markets perspective. I think broadly, I think it's a pretty wait and watch in terms of how does it unfold. So today we have two large issues to think about. One is the global issues in terms of the trade tariffs happens. Second is also in terms of earnings. Does the earnings stack up in terms of expectations? Yeah. There are some amount of green shoots in the economy, but we need to see that how does it reflect in terms of the company's results. This is what I do think about. How do you to navigate next 3 to 6 months.
I quite like the rear mirror view insight that you gave.
I'm in the market for the last 25 years. I think one thing which I always track is on the earnings side. If the earnings is good, the economy will do well, I think. So lots of ifs and buts. I think next 2 quarters can be time tested for Indian capital markets.
Okay. Shreyas, coming to you, how do you view the supply chain dynamics playing out globally? Does India stand to benefit from any of it? And what also about your inflation expectations? We have seen inflation coming down. Do you still think inflation will continue to be down with respect to India and also with respect to the US?
Sure. Definitely India should benefit. Here first, but one need to think about that whether tariffs are settled. The relative tariff settlement is more important because decision of investment will not be taken till the time you have a certainty about it. Yeah. So that's where if you notice that currently generally it would be a phase of indecision in global corporates. So during this phase I don't think the decisions will be taken. Once this relative tariff will get settled, at that time people will take decisions. So there are a couple of examples in it. So if you talk about India's comparative advantage, what you call about, this comparative advantage of India has always been in service sector, and irrespective of whatever is happening globally, we have done well. This is there also in the chemical sector. The industry is existing still since 1970s, 80s, and even prior to that, some of the companies are there. So industries where we have that comparative advantage, which is chemical, pharmaceutical, auto ancillary, these industries I think will benefit eventually once this relative tariffs is settled. Okay. Now coming to new industries, so where we didn't have comparative advantage so far, wherein because of the right steps which are being taken by government for last 10 years, the industries like electronic manufacturing services has emerged. The industry where many private sector is investing is in solar manufacturing. So that kind of industry, in my opinion, will take some time. There has to be push and pull. One classic example has been about Apple. So Apple has been the largest exporter out of China to US. Now they have decided, not because of tariff, even some time back they have decided almost 5-6 years ago that they want to shift their supply chain and they want to diversify more than shifting. In that process already India is almost $10 to $15 billion when it comes to the exports from India, when the exports from China would be somewhere around $70 to $80 billion for them. So this process is more driven by the companies and many more such companies taking this decision would lead to further growth in these segments where India traditionally didn't have comparative advantage, but it is gaining because of this tariff.
Okay. Gop, in your view, what are the key triggers for the markets, for our Indian markets and the economy going forward? And also, do you think financialization of savings have really helped the markets?
Yeah, I think largely I do believe that whatever we've seen last 2 decades in terms of the people coming to the markets, especially coming to the financial market, including banking, is just because of digital. I think thanks to our complete stack across, we call Jandan stack, I think it's done pretty well. Yeah. More and more people are able to access financial market much more easier. We have seen that financialization, and more and more people are using UPI today. Yeah. I think a lot of Indian citizens are coming to a much more formal economy today. I think that's a large chunk of people coming in. I think behaviorally they may be a bit different, but I think there is a fair amount of objective behind coming to the financial market. So very clearly that number of investors or number of people opening bank accounts are becoming much larger here because of the digitalization what we have done. My belief in terms of markets we clearly look at for another very short period of time, which I've always alluded before I started off, is that it's again about earnings, how the earnings looks like, and Shreyas also touched upon on the tariffs, how the tariffs gets impacted on the corporate results, very critical to look at. So I think in my view is that we will go through a bit of a pain. In my view is that we have seen almost 5 or 6 very deep cycle. I think I have seen very closely on 2004 cycle when I started my job. That's the day when in the capital market job in 2004, I was near the BSc that time, and I think the market went on a circuit. A lot of people called me and told me that you came from a car finance and got into equities and what happened to you. And there's a third day. I thought that day I lost job and I thought that I had a small investments in equity side. I thought that also became zero that day. And I also saw 2008 when things were very bad. I've seen 2014 when markets never moved anywhere. Saw 2019. What I'm trying to say is that markets will have cycles. The cycles can be sometimes will be largely painful, but I think patience pays. I think I have seen the outcomes of patience is much larger than people who have less patience. I think people do regret. That's why we call about something called FOMO. The FOMO acts there some point of time. I think my view is that you need to stay invested. You will see the outcome much better than what it is today.
I completely agree with what you have said, and also taking from your experience of 2004 versus now, I think Nifty would have been somewhere around 5,000 then, or perhaps even lesser, to 25,000 now. It's multiplied so many times.
I still believe that. I still remember that 10,000 Nifty where there were the large TV network people used to wear T-shirts and celebrate. That it was 10,000 Nifty, and it was that we thought that it is the last thing what will happen. I think there's a lot of celebrations that time when we large. I think it's unbelievable track. If you look at 9-year data, consequently the equities have delivered positive returns.
2024 was the ninth, I think it's the 9th consecutive year of return, so that's actually quite a lot. Thank you, Gop. And now coming to Shreyash, let's talk about your funds. I have a couple of your frontline funds, the Axis Blue Chip Fund, the Axis Mid Cap Fund, the Axis Small Cap Fund, and the Axis Multi Cap Fund. How are you positioned in these funds of yours? Could you share your views, please?
So the common theme in all funds always has been that it's a bottom-up stock picking that continues. Coming to the overall context of the market, especially since we have spoken about 2-3 things, Gop has spoken about earnings as well as overall markets valuations, and you have brought in point of tariff as well. So point is that there has been multiple moving parts in this. In this all the 3-4 angles. One is slowing down of earning growth, what we have observed so far in this financial year. Secondly, tariff, and third is about overall sector allocations within this. In this, what we have done is over last 6 months. So it is not just because of the tariff or current thought which all of us have on the top of our mind. So the changes are not because of this. The changes in the portfolios have happened more because of the relatively high valuation in high growth stories, which was prevalent actually in September more so. So July to September, that time period, the valuations were very high in high growth stories. It was also because of the slowdown which was happening. So net outcome is that if we take funds like mid cap, small cap, multi cap, there the exposure to investment and export part of economy would have come down from 5 to 8% in last 6 months at a fund level. individually, and obviously the stocks are different everywhere and the sub-segments are different, but broadly 5 to 8% reduction which we have done, and again as I said, it's not triggered by the tariff, it was because of the multiple reasons. In case of large cap, because that fund was always about lesser in investment and export part of economy by design, because in large cap there is only IT services which is there, which is in the export part. Apart from that, not many sectors as such which are directly exposed to the US economy and world economy. So to that, in that context, probably blue chip would have seen about 2 to 3% shift from export and investment to consumption, while these companies have seen a lot more shift. And particularly in consumption, we generally classify financial services, because end of the day it is about retail credit growth. Financial services has been. So particularly that allocation went to financial services, that allocation has gone to pharmaceutical sector. So these are the two sectors where bulk of the money has gone in last 6 months.
Okay. Can you also talk about your Access Growth Opportunities and Access Multi-Cap Fund? And while you've said all of this, now stock picking becomes very critical. So how do you view your stock picking efforts in light of all these?
Sure, definitely, and these two funds rightly were chosen more because here there is no allocation to large versus mid versus small. So by design, these funds are allocating a particular amount to large, mid, small. So when it comes to multi-cap, it is 25-25 which we are running for now sometime, so it is not now. So for some time, almost 5 to 6 months, we are running 25-26% in mid and small individually in multi-cap fund, while in case of growth opportunity also, it is at that border of the mid-cap, which is around 35 plus. So when it comes to both this fund, the individual stock picking and the reduction, where as far as the sectors where the valuations were high, that pattern is same. So in that pattern, these two funds were more in auto ancillary. So auto ancillary has got reduced again over 6 months in these two funds particularly, and capital goods. These two segments were reduced big time. And as far as deployment is concerned, it remains the same, the three sectors which I spoke about. So that pattern has been the similar. So broadly the pattern has been similar, and based on bottom up stock picking, we are going into multiple individual stocks, because in small cap there are opportunities are different, in mid cap the opportunities are different. Investors should keep in mind that end of the day, the mid and small cap category and many stocks in that category are growing faster than the large cap, because just now I highlighted that Nifty growth is closer to a single digit, low single digit. So but then the valuations are high, and that's where you have to take that measured call of valuation versus growth per se. Particularly about growth opportunity fund, where we also invest into the foreign equity. Actually over last 1.5 years, we have reduced our foreign equity exposure from higher, more than 20% to almost sub 10%. And this reduction has been again on account of multiple developments worldwide, including the recent one. So with these developments, we have definitely reduced exposure to the foreign equity.
So when you're talking about domestic, there are also some international funds that you look at. How are you looking at the international funds then?
International funds, so we have certain passive funds and some fund of funds which are we are running here. In the current scenario, definitely it is very tricky to choose a particular country over other. In international also, I would believe that it has to be more a stock pickers market. If you look at the developments in tariff and its impact, so first there are impacts which are being talked about. Again here, why I'm saying talked about is because nothing is confirmed, because the things are so fluid that one day the tariff is different, another is different. But the broader trend which looks like so far is money moving out of US so far it has observed, whether it is treasury or it is about equity. So that has an implication on high or expensive pack of US, which is Nasdaq and oriented companies. It has its repercussion on similarly expensive stock across market, including India. So you notice that some of Indian stocks has been highly correlated to the Nasdaq because of its absolute valuation as such. So it has a multiple repercussion on the valuations also, it has a repercussion on growth also, and that's where choosing this is very tricky, and that is one of the reason why overall we have reduced exposure to the foreign in our growth opportunities where we have a choice.
Okay. Now coming to Gop, when you were talking about your experience and you said in 2004 you thought that your equity investment was almost zero. Now this is what happens, when markets are falling. Most of the investors think, whether we are just going to incur losses, what should we do? Should we just, exit? Should we continue? So there are always nervous minds and nervous, sentiments around. How would you invest? How would you suggest investors to stay invested in these turbulent times?
See, if you look at most of the investments, there is a disclaimer, right?
Yeah.
Investment are subject to market risk.
Absolutely.
In my view, it is investments are subject to your emotional risk.
Absolutely, well said.
Okay,
Yes,
that
it
emotional
is.
risk is what defines your asset allocation.
Yeah.
And most of the people knowingly, unknowingly runs this something called as emotional risk.
Yeah.
Let me tell you a couple of emotional risk is that my colleague has stopped SIP, should I stop SIP? My friend said that today markets are lower, I should put more money. So there are multiple emotional risks what you run through the market. I think so I always define this, that when I look at my own investments or when we suggest to our customers, I just look at it and say that whether these customers are worried about market risk or emotional risk, I think 99% of the investors are driven by emotional risk, not by market risk. I think today if you look at last 30-35 years of the markets today, customers are evolved. The new set of investors coming are much more educated. Thanks to our world of digital, they take their own decisions. They understand market risk. I think what investors don't understand is your own risk associated with you as personally. I think my simple word is that stay invested. Do our asset allocation properly. I think very important to make sure that asset allocation is important. The third point which was very closer to me is that how well you do your financial planning, because ultimately asset allocation and your emotional risk is all about saying that I need to achieve these financial goals, and that's what drives my risk of emotions. I think as long as you are able to control your emotions, your outcome is going to be fantastic. And I have seen that in my last 32 years of job of advisory. I think how can you manage your own emotional risk? As long as you manage that, I think you will do well. Outcomes can be fantastic.
I like the fact that you're talking about asset allocation, because in a rising equity market, investors forget to allocate money to debt funds or hybrid funds. All they are looking at is equity funds. So that is where asset allocation is really very important, and rightly said. Now, Shreyash, coming to you, how do you think the situation, how should investors, why should investors stay invested, and how differently could, they think about markets?
Sure. Actually, on the markets, Gopal has already spoken about in detail, but just few points to elaborate more on that is if you just go back multiple, so to say, black swan event or crisis-like event in last 4-5 instances, which includes COVID, which includes ILFS, which includes twin deficit crisis, and then GFC in that order. Most of the time, and if you take the recent one, which is COVID, the first reaction which market gives is on the near term earning. So obviously everyone is watching out for how much is the earning cut. But to me, FY26 earning cut, to that extent market has and individual stocks have already corrected to the extent of earning cut. One may have an argument on whether it should get derated, is a different argument. But when it comes to earning cut, the stocks have corrected. And the same thing happened during the COVID times. And the call was on whether FY22-23 will be worse, same as FY21. It turned out to be superior than 21, and that's how the market got re-rated from that. Here also, as far as FY26 is concerned, though everyone may watch out for how much is the earning cut for 26. To me, my stocks have fallen to that extent already. The call is on whether FY27 is going to be a recessionary year for US, and whether then associated companies would take a hit during that time, whether the tariff settlement may not happen by that time, or the global corporate sector, whether they are not going to come out of this indecision phase by that time, and then it will have impact on FY27 as well. That is what exactly, in my opinion, is not in price per se. 26 earnings, as I said, in my opinion, is broadly in price. So the investors, considering this risk reward framework, already at Axis, what we are trying to look at is whether the multiples of any sector is too away from its last 10 years average multiple, not the post-COVID rally part, even the pre-COVID, including the pre-COVID rally part, pre-COVID market part. The reason is, every stock one should look at that whether there is a reason why it should be at higher multiple. If it is, there is a justifiable reason for it. So it may be in case of, say, electronic manufacturing, where there is something which is happening. So some stocks you may think that yes, it is justified. But if some stocks, if they are not justified to be higher multiple compared to the longer term average, then one need to think twice, because in this uncertain environment, it becomes very crucial to follow this discipline as such. So that's what we are trying to follow at Axis. And as an investor, I would also suggest investors should do it. As far as a mutual fund investment, and that's where at a professional level we are looking at all these parameters and accordingly building a portfolio wherein the correction is sufficient, and in FY21 whether the company may benefit because of its comparative advantage. So those stocks, etc., what we are trying to accumulate at this point in time, if the correction is very high. And in this process, when it comes to investors' decisions to time the market, I would always say that better avoid the decision of timing the market. The time spent in the market will benefit them more than timing it.
Okay. Now, Gop, coming to you, you are quite passionate about passive funds. Now, we have spoken all about active funds. This also holds true for passive funds. But if you have to talk to investors about passive funds, what would you want to say?
It's quite unfair sitting next to Shreyas, being an active fund manager, talking about passive, but I think passive has a role to play in the customer's portfolio. I think that's the point which I'm trying to say. I'm not saying that there is a big debate in our whole industry that active will work or passive. Globally also there's a lot of conversation around it. I think my view is that as long as you look at a broad-based passive funds, I'm again saying that avoid thematic passives. Don't complicate by doing factors, low walls, and all these things. I know my product guys may not like the way I'm saying. I think what you need to look at is pure vanilla product, because these are broader indices. You look at Nifty 50 or a Nifty 100 or Nifty 500. I think there's a role to play in your portfolio, and use that. How to use that in terms of maximizing your returns is what you need to think about. Having said that, I think there are distributors, there are advisors will help you in terms of building that portfolio. I think it's a very easy product to look at because it actually replicates the performance. So if you look at, you spoke about the Nifty being at 10,000 and we celebrated. Look at now the Nifty, what numbers are.
Absolutely.
And it just reflects that return there. So if you would have bought a Nifty index. So my view is that more the broader index, I think your risk levels are lower and you can participate at the broader level of the market. I'm not the camp saying that you should not invest in active, but it is all about, it has got a fair amount of allocations on your portfolio.
And this also becomes a part of the asset allocation strategy as such.
Yeah, I think my view is that it's not much more of asset allocation, it's more from saying that I have a set of active products and there is a, from an asset allocation perspective, let's think about this, right? Equity as an asset class and we want to allocate from a mutual fund perspective, and you should have some allocation to our passive funds. I'm not saying that active fund managers don't beat it, but passive funds also have an advantage of cost ratios. The cost is much cheaper hence you may expect some return better. At the portfolio level, both active and passive put together, it should look much better.
Okay. Any closing comments that I can expect from Shreyas first and then from Gop?
So always during this uncertain time, the question is, the major question comes is whether we should put money now or over a period of time. To me, here the discipline is most important part, rather than trying to take a view on certain events, because most of the time when markets move a lot and volatility is high, the events are very unpredictable for anyone to paint a picture of how the world would become 1 year, 2 year down the line. And in that sense, having faith or putting money where you have faith in those companies as a shareholder is the most important. That faith in promoter, the faith in the business model, rather than trying to link too many things around it, that how the world will affect the company, etc.
Gop, what about you? Any last thoughts?
Yeah, I think when you really look at for markets from a long-term perspective, I think you will have these bumps and you will have ups and downs, and it will continue to happen. I think markets are not linear.
Yeah.
Markets will never become linear. So somebody thinks that if I will invest money, I will have very linear growth in terms of my returns. I think that's one thing we need to think about. That's not going to happen.
Yeah.
Having said that, my worry still continues because there are large amount of investors came last 3-4 years. They have seen a pretty linear growth.
Yes, absolutely.
And if you really think about why did they come to the market, because they were chasing returns. I think people were chasing returns. I think people were looking at purely from fund performance perspective and putting money. And obviously social media gives a lot of insight about which is a top fund. I think what is missing is that what is that risk that fund manager has taken to deliver that return is what is the bigger question.
Yeah.
I think in my view is that if you really look at the most recommendation, you will get an answer there in the sense that how much risk the fund manager has taken and how does he deliver return, and what happens if the markets gets corrected, and how much of the market losses will happen. I'm not using the word called drawdown because most of the retail investors. I think you need to be very careful by choosing the return, choosing the fund, not just going by pure return. Please look at composition of stocks and what are the risk for the fund manager taking. The last point which I'm going to tell you is that these markets will have this cyclical in nature. It is cyclical in nature. You need to ensure that your asset allocation is important, stay invested, and try to reduce your emotional risk quotient as much as possible. I know there will be dinner table conversations among the working couples. There is a conversation on lunch rooms in the offices about how much losses we have done for the day. I think these are temporary, but as long as invested, the outcomes can be fantastic.
I think conversations has actually moved away from how much profit we have made to how much losses we are incurring now.
That's why the conversation is all about how much you lost for the day. I think if you look at from an equity as a perspective, I think you should not look from a very short-term perspective.
Absolutely agree on that.
Equities are very, by nature, is a very compounding instrument. I think as long as you think about this, I think you will not have very so-called my emotional risk, which I've been talking about. I think I repeated some 5 times today.
Yes, but I think it's absolutely well said, and emotional risk is the biggest risk investors face actually more than anything. Thank you so much, Gop and Shreyas, for your wonderful insights today, and I really hope that you all investors have some key takeaways from this conversation. Thank you for joining us today on a Friday. Have a good weekend, and thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.